And we are back at the conference. Welcome back, everybody. We have a special guest coming up. He is the product manager of Gnosis Conditional Token Framework. After creating DAO Hub in 2016 and retiring from his professional basketball career in 2017, his primary focus has been on DAOs, Ethereum-based governance, and fund allocation models. He was born in Melbourne, Australia, currently lives in Durham, North Carolina, the United States of America. Please put your virtual hands together for Auryn Macmillan. Welcome, my friend, and the virtual stage is yours.
All right, thanks so much for the intro, Chris. I guess I'll go ahead and just jump right into screen sharing. Chris, you kind of covered it all already. So here we go. Let me just hit the button. Today, I'm which is a kind of an interesting use case that we've uncovered for Gnosis's conditional token framework. And I guess a quick couple of caveats before we dive into it. I don't know much about investing. I'm not an investor. And I don't know much about DeFi. I've been in the Ethereum space since Ethereum began, but DeFi has never been my focus. It's interesting to me. I just haven't had time to dedicate to it yet. That said, I do know a lot about governance models and kind of Ethereum as a whole. So we'll jump in and have a quick primer on prediction markets. The Gnosis Conditional Tokens framework was designed to facilitate the creation of prediction markets. So we'll start out with a quick primer on kind of what they're good for and how they work. In essence, prediction markets are markets on future outcomes. They allow you to buy a position in the likelihood of an event happening in the future. They're particularly interesting to me because they financially incentivize information sharing and information aggregation, which is great for governance. You can make better decisions if you have more information. So they might ask questions like, will Ethereum 2.0 launch by 2021? Or will Donald Trump win the US presidential election? Or, went a bit farther, will a vaccine for the coronavirus be approved before the end of 2020? A quick TLDR on how they work. Each market has some underlying collateral. One outcome token represents one unit of that underlying collateral. And when the market resolves, holding an outcome token lets you claim a unit of that underlying collateral. The price of each outcome can be interpreted as the probability that the outcome will happen. If you believe or know that an outcome is underpriced, that it's more likely to occur than the current odds, you're financially incentivized to buy that position. And in doing so, you share that information with the market. When a market resolves, holders of the winning outcome token earn an equivalent amount of the underlying collateral. More complex combinations of questions are enabled by Gnosis's conditional tokens framework. With this, you can ask and buy positions in the likelihood of an event, the likelihood of how an event is affected by another event by combining two existing markets. So you could ask, if Donald Trump is banned from Twitter, will Donald Trump win the US presidential election? Through a combination of positions in the markets, will Donald Trump be banned from Twitter and will Trump get reelected in 2020? This also allows you to ask how an event will affect the price of an asset. So how will the ETH price be affected if Ethereum 2.0 launches before 2021? And something that's really neat that you can do with that information is make a trade under the condition that a specific event occurs. So you could say, I'll buy Ether, but only if Ethereum 2.0 launches in 2021. This last category of question is what we're calling conditional investment, and it's what we'll focus on today. To make a trade like this, we need two parallel instances of the same market, but with different underlying collaterals. For example, one with US dollars, probably DAI or USDC, and one with Ether, that's exactly what we have with these two markets up on Omen. For anyone that's not familiar, Omen is a prediction market that was released recently by the DXDAO. You can find it at omen.eth.link, and it's built on top of the Gnosis conditional tokens framework. So here we have two identical markets with different underlying collaterals. One is USDC and one is Ether. So if we believe that Ethereum 2.0 launching before 2021 will positively affect the price of Ethereum, then we can express this by buying the no position in the US dollar market and the yes position in the Ether market. And by buying just the right amount, we can make this as a conditional trade where if Ethereum 2.0 launches before 2021, we buy Ether, or we kind of get Ether back. And if it does not, then we get our US dollars back. I'm going to jump over to another tab here so we can explore kind of a toy model that I made up to dive into this. I'll zoom in a little bit. Hopefully you guys can see this all right. So here we have our two markets with the same question. The odds are slightly different, and you'll kind of get to understand why as we go through here. But we're going to go through two kind of model scenarios, option A and option B. In option A, we essentially want to buy Ether if Ethereum 2.0 launches before 2021. And in option B, we want to buy Ether if Ethereum 2.0 does not launch before 2021. And we'll see why that is also an interesting buy later on. So here we'll go through some kind of steps to make this happen. So we'll assume a starting balance of 100 USDC just for easy math. And we're going to buy the no position in the USDC market. We're going to buy the exact, the relative kind of percentage of the no position. So we started with 100 USDC. We're going to buy 35.54 USDC worth of no shares. And so that'll give us 100 shares in the USD market. Then we'll trade the remaining USDC for Ether at the price when I made up this model. It's obviously gone up a little bit since then. We'll trade the remaining USDC for Ether, and then buy that 2.0 Ether worth of yes shares. And so that'll give us 0.298 yes shares in the Ether market. And what this does effectively is give us a scenario where if Ether launches before 2021, then we buy 0.298 Ether, and if it does not launch before 2021, we get 100 USDC back. What this effectively means is that we're willing to buy Ether at the price of $335 as opposed to the current price of $322 in the case that Ethereum 2.0 launches. Now, if we go through and make the opposite sequence of trades, we have a starting balance of 100 USDC. We buy 64 USDC, so the yes side in USD. That gives us 100 shares in the yes side of the USDC market. We convert the remaining USDC to Ether, so we get 0.11 Ether, and we buy the no side of the Ether market. We end up with 0.33 shares in the Ether market. And that gives us a price of $300 US. And so effectively here, this is an interesting buy if you think that this event not happening before 2021 will negatively impact the price, or at least if you think that it won't, the price will not be lower than 300. You're effectively buying Ether at a discount based on the fact that you don't think that Ether will launch. And if it does launch, you just get your 100 USD back. Now, the interesting thing from my perspective here, what you can kind of derive from this information is this number here. Essentially, the difference in value that the market is predicting based on whether or not this event happens, whether or not ETH 2.0 launches in 2021. This is a really, really interesting value because it is useful for decision making in kind of formal or informal governance. So if using kind of a more contrived example, if we had a project who was looking to make a decision on whether or not to do something, then they can use this this kind of predicted impact as a metric to help make a decision on that. And we'll dive further into that in just a minute. Another example that I have here is based kind of more around price. And so this is maybe, I guess, makes the difference in price a little bit more explicit. So here you'd say, will Ether trade above $500 on November 1st? So with the current odds, the buy scenario here is almost identical. So we're saying we want to buy option A, we want to buy Ether if it's, I guess I've got the text wrong here, but we'll imagine that it says this, or I can quickly edit it on the fly. Close enough. So here we see that the predicted price of Ether, the price that market participants are willing to pay in this market for Ether, is slightly above $500. So the upside here is that if it does trade above $500, you're buying it at that price. And if it trades anywhere further above that, then the rest of it is all kind of gravy. If it trades below $500, then you just get your USDC back. Conversely, if it does not, if you've bought the opposite side of it here, where you buy yes in the USDC market and no in the ETH market, then any price basically between the predicted price here of 235 and the opposite side of the market, the predicted price of 500, is essentially kind of gravy for you. So there's this huge kind of potential window for both sides to be attractive trades, depending on what you believe the outcome to be. And in both cases, if you're wrong about the outcome, you get your initial balance back. And so that's why we're kind of calling it conditional investing. So I'm going to jump back over to the presentation here, and we'll move on to talk about Fusaki. So while the concept of conditional investing in and of itself is really cool, the more interesting use case, in my opinion, is for Fusaki, which is governance by prediction markets. Essentially, the organization defines one or several metrics that it wants to optimize for. To keep it simple, let's say we're talking about an organization with publicly traded shares. So this might be kind of governance tokens, it might be stock, it might be something else entirely. It doesn't really make a difference for the purpose of this example. It's just you have some kind of publicly traded governance token. The organization wants to make decisions based on which projects to fund based on how likely they are to affect its share price. In order to be accepted, a proposal should positively impact the price of the organization's shares more than some threshold, say 5%, within some time frame, say 1 year. To achieve this, it creates two parallel markets with a question like, will this proposal happen by 1 year from now? One with USD as collateral and one with its shares as collateral. The organization then picks some future dates, say a few weeks later, on which to analyze the market's behavior and come to a decision on whether or not to fund the proposal. The decision-making process could be algorithmic in the case of a DAO, or it could be bureaucratic in the case of a more traditional organization. If the market predicts that the share price would be at least 5% higher if the proposal happens, then the organization funds the proposal. If the market predicts less than 5%, then the proposal is rejected. And when I say predicts that percentage, I mean through the mechanism that we just went through with those conditional trades. The really cool thing is that you could do this with any metric that can be tokenized. So with synthetic assets, that can be literally just about anything. So share prices, future revenue, carbon footprints, user numbers, whatever metrics matter for your organization. So that wraps it up for the conditional investment chat and kind of ties it in with why I think it's interesting from a governance point of view. This is your opportunity to learn some more about conditional tokens. I'll hang around in the chat and answer any questions. If you want to kind of keep the discussion going, jump over to chat.gnosis.pm and we can keep chatting there. If you want to learn more about the conditional tokens framework, head over to docs.gnosis.io/conditional tokens. I'm Auryn Macmillan, product manager at Gnosis. Thanks very much. This was a lot of fun. Yeah.
Hey.
Howdy.
Hey, Auryn. How's it, man? You're speaking to Theo. Thank you so much for that. Really appreciate it, man.
Not a problem. That was great.
How long have you been working on the project for?
So I actually just joined as the product manager at Gnosis only a few weeks ago, but I've been involved with Gnosis since 2016. So kind of on and off since 2016 in various capacities.
Okay, perfect. I'm going to open the floor up. Let's just wait a couple of minutes and see if there's any questions at this moment in time. But other than that, what I wanted to say is, if you're willing to share your screen, one of our ladies or our team will actually contact you and just ask you to share your slides with us, and we'll just upload it for the community.
Yeah, totally. I'm more than happy to share the slides. They have a kind of the script and everything there as well, so it should all be fairly accessible.
Okay, perfect. So if we don't have any questions, then we might as well just end the
perfect
session. Thank you so much, Auryn.
Cool, not a problem. Thanks, Theo.
Appreciate